The crypto markets are absolutely plummeting. This is happening right now. It feels like an emergency, but let me explain why this is happening and how this could present one of the best opportunities that we have seen over the last few days to make some serious money out of the markets. So take a look at this price action. Bitcoin currently at a price of $120,861. We are right now, at the time of recording, about to challenge this low that we put in on the 7th of October, down at 120,656, 120,650. And we can see, if we look at the CoinGlass liquidation map, there are approximately $57 million worth of long positions that will be wiped out of the market if we come down to break through these lows, and it is looking more than likely that that is going to happen. Now, as I've discussed previously, we know that retail traders love to put their stop losses at lows, okay? Lows such as this one. We also know that retail traders love to jump in with leverage. They have potentially an incorrect understanding of leverage, and that means if prices come down to challenge those positions, they are likely to become liquidated, likely to become forced to sell out of those positions. And when that happens, when they are forced to sell, they are essentially dumping supply on the market. And because of the laws of supply and demand, that can lead to a situation where moves get escalated in either direction. And that is what we've seen over the last few days trading. If we take a more historic view of this liquidation map, we can see that there has been a huge amount of liquidation risk on both sides of the market. And that is what has caused this wild price action that we've seen. Now, you'll know if you watched yesterday's video, the video before that, I've been in a long position. I actually got long because we saw this fall coming and we strategically placed some buy orders to capitalize on that and to get long, knowing that ultimately prices would bounce back from that fall. And we knew that this fall would be fairly dramatic. That's how we theorized that prices could then bounce back from that, because essentially this would be an extension down below where fair value is in the market, and that extension was caused by leverage, people being forced to sell out of those leverage long positions. And this played out pretty well. Okay, so we took out the first portion of this trade up here somewhere. We took that out for about $350. If I take a look here on my price history, that was this trade here on my P&L, okay, $350 up. Now, we had a couple of other opportunities, even just within the last hour or two, to take more money out of that trade. So we took a portion out of that. Here, first of all, I had another take profit order set up here somewhere around the region of $124,500. You can see that was not hit. Okay, so we didn't manage to get out the second take profit from this trade. Prices then started to cool off a little bit from here, and then you can see we bounced a little bit more, and suddenly, boom, look at that big drop. And once again, this was perpetuated by leverage long positions becoming liquidated. These were long positions like my leverage long position, although I was not liquidated because we were in this position at much more favorable prices down here. And that is because we planned ahead for this, okay? We were 1 to 2 steps ahead of the market in this case. We weren't just blindly following like sheep, like the majority of retail traders do, and jumping on the bandwagon. Oh, the price is going up a little bit, so I better get leveraged long. And then when the price comes down just a little bit because of a poor understanding or at least a poor use of leverage, those positions get blown up and then they are forced to sell on the market, and you get overextended moves like this again. Range bound for a little bit. Then we bounced. Once again, I thought I would have another opportunity to get the rest of this trade out of the market, close it off, because by this point I'm starting to think, okay, this isn't playing out in exactly the way that I wanted it to, right? We got the first bounce. We made some profits, but what we were really hoping for was a strong and powerful move up from these lows, and that is not what we were seeing. Okay, so price came down, milled around a little bit, we shot up again, couldn't get my position out, and then suddenly look at this, we were just smashed back down again. So what happened essentially with this trade is we went from being well ahead of the market in our theory to being right in the pack of the market, except our pricing was still favorable. And then it got to the point where, because prices were coming down, we were no longer competitive with the rest of the market, and we were just getting beaten up like everyone else. So I elected to take out the rest of that position at break even, which means we are still net up $350 for this trade. I got out of that in a number of different tranches. I didn't just let the stop loss take this one. I exited manually. So what am I looking at now? Well, This low here that we just challenged a couple of moments ago is going to be absolutely key. If we break down beneath that low, we have then essentially confirmed what will be a downtrend since we made the all-time high. That has a strong psychological element in itself. It is a change of market structure. The next most important thing about this level is the fact that we know these retail traders, we know traders of all types, in fact, like to put stops around lows, okay? And when a stop loss goes off from a long position, that equates to selling. And we know because of the laws of supply and demand, a lot of people selling at the same time around the same price equates to a lot of supply being dumped on the market. Supply increases, demand stays the same, etc., etc. You know the story, the price comes down. This also correlates to liquidation risk. Okay, so we could see that effect represented in a different way in the form of the liquidation map. Now beneath that, we've got another key low here, which essentially was one of the structural lows, we'll say, from the uptrend that we put in from this whole mega up move. And that is coming in at about 119,300. That equates to $626 million worth of long liquidation risk. And this is an important part of the liquidation map, okay? It's an important feature to pay attention to, because this is where this curve kind of starts to flatten out. So that's kind of the most bang for your buck in terms of liquidating long positions, right? One more detail to look at. You can see that we are much steeper on the left-hand side, much steeper on the long side of the market. That means we are much closer to long liquidation risk than we are to short liquidation risk. Essentially, our liquidation risk, right, is focused around this region here between these two key lows. The first one is the most important. Okay, look at the shape of the chart we're putting in here, right? Even just now, I would wager that there will be people trying to get long right now, and they will be placing their stop beneath these lows. The next key price to the downside, which comes in at this area here, $118,000, which was formerly resistance, okay, from the last impulse move up. This would be a very natural place for the market to move, okay? I don't think it is wise to rely on technical analysis solely. It is a tool in the box that we can use to look for confluences. We're trying to make sense of fundamental data. At least I think that is the best way to interpret technical analysis. And we have orders in the book ready to capitalize on this situation, okay? There are going to be more than likely a lot of liquidations before the evening's over. So my first buy order is actually all the way up at 119,600. This is essentially, and this order might be removed, by the way. So $119,600. This is basically me preparing for a scenario where we don't break this low. Okay, just in case we don't, I want to have a trade in the book. I'm going to be watching what happens as we break these lows, if we break these lows, and I will want to try and call in the moment if we're breaking that aggressively enough for me to warrant leaving this order in, maybe bringing some of the other lower buy orders up, or removing this buy order. Okay, if we're moving really aggressively through these lows, I want to get that out because I think we're going to go further, and I think we're going to break this low. Down from there, I've spread out the remainder of my buy orders at 119,000, and then I've got another one a little bit lower, actually at 118,600. Now, why do I think prices are likely to come up again from this? Well, first of all, when liquidations go through, it's fair to say that the price has detached from its fair value, okay? And that's because these moves get overextended by a sort of synthetic force of selling in this case. When someone's liquidated, they are literally forced to sell their position. They didn't want to sell, they just sold because they had to sell. The opportunity here really is to buy at prices that are unfairly low, essentially to what the market should be trading at if it was just a spot market and there were no liquidations. And by doing this, essentially you're trading a lot more like the big guys, right? Although they have been buying all the way up here, they bought a lot more at cheaper prices, and they prefer buying at cheaper prices. So there you have it. I am out of my former long position. We got out of the rest of that trade at break even, but we are up $350 net for that trade. I'm pretty happy with that. It wasn't what we were looking for, but it is a win nonetheless. And I'm going to redeploy that capital into the next opportunity that I can see, which is, I believe, more than likely a big drop in the markets tonight, down to some of the levels that we've discussed. As always, though, that is just my opinion. That's just what I'm looking at, shared with you purely for entertainment purposes. Nothing I say should be considered financial advice. Thank you so much for watching. Plenty more to come. Catch you in the next one.